My name is Chris Downham, editor of Best Fixed Rate and managing director of Simplicity Financial Services. This is now the fourth time I've done this video. I keep forgetting to either plug the microphone in or switch the video camera on. It's driving me nuts. The weather today is absolutely roasting, so I shall make this video brief so that you do not witness my head starting to change colour. So with the weather experiencing an Indian summer, can the same be said for UK property and mortgage market? This brief update will give you the key developments in September 2011, or from September 2011, and paint a picture as to what the future might hold. Firstly, house price movement. Every month, Nationwide release the Nationwide House Price Index that is supposed to be one of the most accurate reflections of what is going on with UK house prices. The conclusion was that house prices increased by a totally underwhelming 0.1% in September, although they were still 0.3% lower than the same time last year. So it appears house prices are going nowhere fast. The weakest area was Northern Ireland, and the strongest growth was still in the capital. I wonder what that would be like if asset-stripping foreign oligarchs deserted the market. Using average figures is always dangerous, but despite some serious corrections over the past several years, if you had purchased a house for $100,000 in the year 2000, it would now be worth approximately $214,000. However, if you had purchased a property in the year 2007, again for £100,000, your property would now only be worth about £90,000. If you're in that boat, our advice would be to use cheap interest rates to overpay your mortgage and try and maximise the equity that you hold in your property so that you can get a decent remortgage in the future. If you did take out an interest-only high loan-to-value mortgage in 2007 or 2008, then effectively you would be unable to remortgage and will be stuck in your property. Well, stuck with your mortgage. Nothing is forever, and speaking to an experienced mortgage advisor like myself from Simplicity Financial Services will always help. Our thoughts are that seasonal house price fluctuations are the norm, and do not be surprised to see house prices drop back in the winter. Good time to buy. 1 year from now, we expect little to have changed, and if we had to commit to either movement in one direction or another, we would say a further small depreciation in prices is more likely. Next, mortgage lending. On the 20th of September, the Council of Mortgage Lenders reported that mortgage lending was 10% stronger than it was 1 year earlier, and that the lending in August 2011 was the strongest since July 2009. However, these figures must be viewed with a word of caution because they're still miles off what they were in the halcyon days of 2005, 2006, etc. So there are these words of caution from the Council of Mortgage Lenders. Much of the recent variation in monthly lending figures appears to have reflected seasonal factors, with the underlying picture being one of activity levels that continue to be subdued but broadly stable. The August performance more or less offset the weaker than expected July figure. Taking July and August together, lending has shown little change on the same months of 2009 and 2010. So in summary, like house prices, nothing is really happening either negatively or positively. Our thoughts for the future are that mortgage lending will slowly increase over the coming years, and that more people will start to appreciate the benefits of more long-term fixed rates, and this will drive up lending, especially when interest rates start to increase, although by then most people have missed the historically low fixed rate mortgages that exist today. And now to our mortgage rate update. During the summer, well, if you can call it a summer, we saw fixed rate mortgage rates break all the previous records, with 5-year fixed rates plummeting below the 4% mark. Great deals. September witnessed many more lenders joining the market, and rather than just Yorkshire Building Society and its subsidiaries charging a loan, now nearly all of the lenders have launched terrific fixed rate deals. Surprisingly, these excellent mortgages left the public hugely underwhelmed. Recently, we've witnessed a drop in the number of people taking out fixed rate deals. Madness. Instead, many people were opting for slightly cheaper tracker deals. Maybe because interest rates have been so low for so long, people are starting to believe they will not change. Of course they are wrong, change is inevitable, and when it happens, many people would wish they had been on a longer term fixed rate deal. To help you make the right decision as to when to move to a fixed rate deal, we strongly recommend, that you download our free guide. Towards the end of September, we saw interest rates from some lenders' tracker products start to actually rise. They said that the reason for this was tougher conditions on the wholesale lending market, and hence banks were having to pay more for the money that they were lending. If tracker rates do continue to converge with fixed rates, then hopefully this will make more people consider the real advantages of a longer term fixed rate deal. Talking of rate conversions between fixed and tracker rates, we are now seeing very little difference in pricing on lower loan to value 2-year tracker and 2-year fixed rate deals. So if you've got a 25% deposit or more and you're looking for a 2-year deal, then we'd recommend a fixed rate over a tracker. Our thoughts are that fixed rate deals will not get any better than they are now. Tracker rates might actually start to deteriorate, and we'd like to see more cap rates return to the market. First time buyers might start to find some more suitable products for them, and loan to values may slightly improve. Although in general we're not really expecting to see any really exciting developments either positively or negatively. Finally, an interest rate update. We always study the Barclays interest and exchange rate monthly outlook to try and get a better idea of what the future may hold, and also the macroeconomic factors that influence UK interest and exchange rates. The net result of September's outlook was that, like house prices and mortgage lending, interest rates are not really going to change, in the immediate future anyway. In fact, it now appears more likely, my computer's just stopped, but it now appears more likely that the next change will be 0.5%, 0.25% down rather than up. Our thoughts are that 1 year from now we will still see interest rates at 0.5%. So hopefully you found this video interesting, but if you'd like any individual advice, please feel free to contact me directly. My email address is chris@bestfixedrate.co.uk. Hope you enjoy the Indian summer. Cheers, goodbye.